Here's a mistake I see people make all the time. They hear about SCHD, they get excited, they open a brokerage account, they throw in a few $100 a month, and then 6 months later they look at their dividend income and go, wait, I made $11 this quarter? And they quit. Or worse, they convince themselves dividend investing doesn't work. But here's the thing. It does work. You just have to know exactly how much you need, how long it takes, and this is the part most people completely skip over, what that compounding curve actually looks like in real numbers, mapped to your real life. Because once you see it, the whole game changes. So in this video, I'm going to show you exactly how much SCHD you need to hit $5,000 a month in dividend income. I'm going to walk you through 3 timelines, 30 years, 20 years, and 10 years, with real dollar amounts at every stage. And I'm going to show you why $5,000 a month isn't some arbitrary goal. It's the number that actually buys you financial freedom in today's economy. Stick around, because the math at the end is going to surprise you. My name is Jake, and I spend way too much time thinking about passive income and dividend investing. If you're someone who wants to stop trading time for money and start building a portfolio that pays you every single quarter, make sure to hit that subscribe button and give this video a thumbs up if it helps you out. Okay, let's start with the why. Why $5,000 a month? Why not $2,000 or $3,000? Look, a couple of years ago, $1,500 to $2,000 a month in passive income felt like a dream. It sounded incredible, but here's what most people don't realize. In today's economy, that number barely covers half your basic bills. I'm not making that up. The Bureau of Labor Statistics just reported a 2.9% CPI increase over the past 12 months. Food is up 3.2%. Core inflation, stripping out food and energy, is still running at 3.1%. And before you say that's not that bad, let me put that in a real money. Groceries for a family of 4 now average $900 to $1,000 a month. Essentials like eggs, meat, and dairy are still meaningfully higher than they were before 2020. But the real budget breaker is housing. The median monthly rent across the US right now sits at about $1,539 a month, up from roughly $1,470 just a year ago. And it's a massive climb from just a decade ago. Over the past few decades, rents have grown at an average rate of nearly 4% per year, while wages have had a brutal time keeping up. The US Census Bureau data shows rent now consumes about 26.6% of the average American's income, up from around 24.5% in the early 2000s. That might not sound dramatic, but it represents thousands of dollars in housing inflation every single year. Now add groceries, utilities, transportation, insurance, and you're looking at $3,000 to $4,000 a month in basic living expenses. That's the floor. That's the bare minimum before you buy a single nice thing in your life. So $2,000 a month in passive income? That helps, but it doesn't free you. It doesn't give you breathing room. It doesn't let you stop worrying. $5,000 a month, now we're talking. That's the number that covers your bills, keeps pace with inflation, and actually lets you live, not just survive. And one ETF has quietly been helping long-term dividend investors build toward exactly that number. If you've spent any time in the dividend investing world, you've heard the name, SCHD, the Schwab US Dividend Equity ETF. But let me go deeper than the surface level stuff, because there are a few things here that most people don't talk about. SCHD launched in 2011. It was built around a simple but powerful goal: give investors access to high-quality, large American companies with proven track records of paying and growing their dividends, all for an expense ratio of just 0.06%. That's $6 a year for every $10,000 you have invested. Compared to what a lot of mutual funds charge, that's almost nothing. Now, you might be thinking, Jake, there are a lot of dividend ETFs out there. What makes SCHD different? Great question. Here's what it gets right. SCHD tracks the Dow Jones US Dividend 100 Index, which sounds complicated but really just means this. Every company in the fund has to have paid dividends for at least 10 consecutive years, have a strong balance sheet, and generate consistent cash flow. In other words, these aren't companies that pay a dividend and hope for the best. These are businesses that have proven they can reward shareholders even when the economy gets ugly. We're talking names like AbbVie, Lockheed Martin, Cisco, Merck, Coca-Cola, Verizon, about 103 companies total, spread across energy, consumer goods, healthcare, and tech. The top 10 holdings make up around 40% of the fund, but that's not a weakness. Those are the most battle-tested companies in the index. Now, here's what I want to address head-on, because critics love to bring this up. Over the past 5 years, SCHD gained about 35%. The S&P 500 gained about 85%. So why would anyone choose SCHD? Here's what most people don't realize. That S&P 500 gain was almost entirely driven by a small group of mega-cap tech companies: Nvidia, Apple, Microsoft, Meta, Amazon, Tesla, and Alphabet, the so-called Magnificent Seven. The rest of the index, much more modest, and that tech concentration also made the S&P 500 significantly more volatile. SCHD, on the other hand, is built for people who want steady income that grows over time. Its current dividend yield sits around 3.83%, and here's where it gets really interesting. Over the past decade, SCHD's dividend has grown at an average rate of over 10% per year. You're not just earning income, that income keeps growing, year after year, even when you're not doing anything. Okay, before I get into the actual numbers, I need to make sure you understand why reinvesting your dividends changes everything, because this is the piece that most people underestimate. Let me show you with a simple example. Two guys, Josh and John, both invest $10,000 in the same dividend ETF. The fund grows 6% a year and pays a 4% dividend. The only difference, John takes his dividends as cash. Josh reinvests every single payout through DRIP, a dividend reinvestment plan. After 1 year, they look identical, both at $10,400. But by year 5, John's sitting at around $12,248. Josh is at about $14,400, nearly $2,200 more, and they invested the exact same amount in the exact same fund. How? Josh's dividends bought more shares. Those shares paid more dividends. Those dividends bought even more shares. It's a loop, a compounding loop, and it's slow at first, painfully slow, but the longer it runs, the faster it accelerates. Over 20 or 30 years, that gap doesn't just widen, it becomes a completely different outcome. And this is the concept that turns a modest monthly contribution into a portfolio that pays you $5,000 a month for life.
All right, here's the part you've been waiting for. Let's run the real numbers across 3 different scenarios based on SCHD's actual historical performance. Roughly a 3.83% current yield, 10.43% annual dividend growth, and 7.69% annual share price appreciation. Timeline 1, 30 years. This one is for the long haulers, people in their 20s or early 30s who have time on their side. And the number I'm about to give you is going to feel almost unbelievable. You need about $7 a day. That's it, $210 to $220 a month. By year 10, you're looking at a portfolio worth around $45,000, generating about $2,000 a year in dividends. By year 20, it's grown to roughly $270,000, paying out close to $11,000 annually. And by year 30, your portfolio is projected to reach around $920,000, paying about $65,000 a year in dividends. That's roughly $5,400 a month in passive income. Your total contributions over 30 years, about $76,000. Time and compounding do the rest. You're retiring close to a millionaire on $7 a day. Timeline 2, 20 years. Now you might be thinking, Jake, I'm in my 40s, I don't have 30 years. That's fine. Here's what that looks like. To hit the same $5,000 a month goal in 20 years, you'd start with around $60,000 up front, then add about $15 a day going forward. That larger initial investment gives you momentum right out of the gate. At the end of year 1, your account is sitting around $72,000, producing roughly $2,300 in dividends. By year 10, your portfolio has grown to about $284,000, throwing off around $12,000 a year, about $1,000 a month. Those reinvested dividends from the early years are now doing real work. And by year 20, your portfolio hits around $1.1 million, generating roughly $61,000 a year. That's about $5,100 a month in passive income. Your total contributions, including the initial lump sum, come to around $169,500. Compounding multiplied it more than 6 times. Timeline 3, 10 years. This is the accelerated path. It's for people who've built up significant savings and want to put their money to work fast. To get to $5,000 a month in 10 years, you're starting with a $350,000 initial investment and adding about $50 a day. In year 1, your portfolio is worth around $385,000, generating about $13,400 in dividends, all of which get reinvested immediately. By year 5, you're at roughly $725,000, producing close to $27,000 a year, about $2,200 a month. And by year 10, your portfolio is projected to reach approximately $1.4 million, paying roughly $61,000 a year. That's about $5,000 a month in passive income. Your total contributions will be around $532,500. Compounding more than doubled it. This is the path that trades time for capital. You're putting in more upfront because you don't have the years to let compounding do it slowly. Here's the thing I want you to walk away with. It doesn't matter which of these 3 timelines fits your life. What matters is that there is a path for you. Whether you're just starting out with $7 a day, or you're in your 40s ready to go harder, or you've got a big chunk of savings and want to move fast, the math works. The mistake most people make is waiting for the perfect moment, or waiting until they have more money, or talking themselves out of it because the first few years feel like nothing is happening. That slow start, that's normal. That's just how compounding works. The growth is exponential, meaning it feels flat at first, and then it suddenly takes off. SCHD has been doing what it was designed to do for a decade: low cost, consistent dividends, growing income. If you start now, stay consistent, and reinvest every single payout, you are giving yourself a real shot at financial independence. So the question isn't whether this works, the question is, which timeline is yours? If this video helped you figure that out, hit the like button, subscribe, and drop a comment below telling me which path you're on. Are you 30-year, 20-year, or 10-year? I read every single one. And if you want to go even further, I've got a video showing you how to stack multiple compounding strategies to push beyond $8,000 a month in dividends. Click that one next.